Hey everybody, David Skurika. So now walking back. So this will come out probably Saturday. Yeah, so to like put in perspective of like now gold, right? So gold was in a bit of a different spot in 99, 2000. Remember, we didn't have the debt problems that we had back then. Debt to GDP, I think, was closer to like 40%. And then I think 40 to 50%. And then the stock market was all-time highs. Everything was booming. We didn't have any inflation. So it was a lot different. So because of all these things, gold was at essentially multi-decade lows, $250, $300 an ounce. You know, come off 60-70% from its highs of 1980, even more inflation adjusted. So we were in a much different spot. But then the dot-com bubble burst, and gold actually went down almost the entire year of 2000 with it. And then, but the gold stocks bottomed in about November, December of 2000 and started to move higher. And then that emergency rate cut in January of 2001 launched it. Like the HUI over the next like 3-4 years to like the end of 2003 went up over 1,000%, and gold went up over 100%. So it was a great opportunity to buy. It was really like I don't say easy, but it was a dream trade at the time, where all you had to do through that whole time period is be long precious metals and short the stock market. It was that simple. So you would get both sides of the trade, right? You say you were short tech, you would have made, and say short tech, just short the NASDAQ, no margin, you would have made 60% or something like that. Like, let's just assume you're not getting the exact high or exact low over a 3-year period. You know, 2001, 2002. So you're essentially annualized 20% on your shorts. And then the gold stocks, like I said, went up 1,000%. So you're up annualized 200 to 300%. So basically, and I think that's what, what's his name? Eric Sprott did. That's kind of what made Eric Sprott really famous, is that he was short tech and he was long gold equities. So now we don't have, like, so for example, then we look at 2007. It's not similar in that the gold and gold equities did very well from 2002 to 2007 during the bull market in equities. And because of that, they got whacked with the rest of the market. Now, we're kind of in between where we were in 2007 and 2000 in that gold and gold equities have had a nice little rally here since February. But compared to gold, they're actually cheaper than they were in 2000. Like the HUI to gold ratio or something like that. And of course, they've lagged for over a decade. So we're kind of like in between, where they've rallied, but they've they're still very, very cheap. So I still think that, like 2001, the catalyst becomes, I think, those intermediate rate cuts. Like when that happened in 2007 until everything crashed in 2008, over the next 10 months, gold stocks did phenomenal from August of 2008 to like the spring of August of 2007 to spring of 2008. And of course, when they cut rates to zero and did QE, gold stocks did fabulous from 2008 to 2011. So when we get these surprise rate cuts or QE or whatever, and same thing from 2020, really for about the next year, I know the gold and gold stocks kind of peaked over that summer 2020, but really juniors, I was in that market. Like I was making a lot of money in juniors in 2020 and 2021. And yeah, everything kind of changed, you know? So, in that market, you know? So anyhow, when the Fed cut rates and did their QE. So when I think we get an emergency rate cut, we all know they're going to cut in September, will still be good for gold and silver. But I think once, whatever, the market goes down enough, or the economy shows enough signs of weakening, and we get that emergency rate cut, I think like January 2001, right, like March, April of 2020, that's the catalyst. So, like I said, we're a little different than in 2000. In that first phase of the bubble bursting, gold stocks moved down with the NASDAQ, and that's not happening. And obviously, I think the debt thing has a major issue to do with it, with the $2 trillion deficit, with debt to GDP being 120%. This is a major thing. you know. So I think gold shares had been kind of anticipating that. And like I said, we didn't have those debt problems in 1999, 2000 because of the big boom, which led to huge amounts of cap gain tax coming into the coffer. You know, they were actually using the Social Security Social Security surplus and moving that to budget revenues to help balance the budget. That was part of this little scam the government ran. We know the government runs more scams than anybody. And so anyhow, that's all I got to say. So yeah, I think even though it's not like 2000 in the sense that the gold stocks have rallied a bit, they're not going to be falling with that first phase of the market. But I think the real catalyst for them really to take off into a new bull market will be some kind of emergency rate cut. So I guess I'll leave it on that. And this should be coming out on Saturday, like I said. And yeah, I'm going to try to get my members update Saturday, because I'm going to be honest with you. On Sunday, first weekend of the NFL season, I just kind of want to sit on I want to take my little walk down here in the morning. And then I want to sit in my butt, eat some chicken wings, and have a few drinks and enjoy the games. Everybody take care. Bye-bye.